Good evening, ladies and gents. We should be live. Are you here? If you're here, say you're here. Let me know you're here. Can you hear me? Can you see me? Can you? I'm not sure if there's a third thing. Hear and see. That's the main things. Let me know in the chat if you are here, so I know you're here. Here we go. Hello. So we'll give it a couple of minutes for all the stragglers to get in. How have you found today? So today has obviously been about your emergency fund calculator. Today's task is quite a simple task, actually. It gives you the opportunity to just put a bit of strategy behind it. Tonight's training, on the other hand, we're going to dig into some interesting stuff. So I'd love to know in the chat how you found today and how you're getting on this week. Are we feeling more comfortable, more confident with what's going on? Are we feeling nervous? Where are we at? What's happening? Tell me. You can also see our star wall up here. So this is all the people that have booked tickets to come to Money Mechanics Live. Your names are all up on our name wall, on our star wall. So welcome. Shireen, you're up there. I can see your name in the thing. Hello. And obviously, as anyone books their tickets, your name will go up there. Ready for the VIP experience? So today we're going to be talking about the garden of growth. So the garden of growth. So very good. Really. I've got a bit of a delay on my chat here today, but that's okay. I'm pleased. This is really good news. Well done. Really good. Really know what you need to be doing now to get back on track. Love that. It was great to hang out with some of you in the VIP earlier as well. Nice to see you all there. A bit more of a personal chat with some of you to give you a bit of pointers. So well done on that. So today we're going to be talking about the garden of growth. So up until this point, we've been talking about kind of the stabilization of your money. From this point onwards, so from tonight and into tomorrow, for you to be able to decide what it is you want to do next, you need to know what your options are, right? So tonight we're going to talk about the garden of growth, which is my analogy that helps you to remember the different types of investments that there are. And we're going to talk about the pros and the cons of each. We're going to talk a little bit about, some examples of each. What you have to understand about tonight is that this is not investment advice. So if I mention a company to you, what I'm not saying is this is a good investment or a bad investment. It will just be the brand that pops into my mind in that moment, right? If I mention a fund to you, if I mention any sort of digital currencies, anything like that, it's not me saying you should put your money there. It's me saying, using it as an example. So are we all crystal clear that whatever I say tonight is not investment advice? Can I just have a little yes or a thumbs up in the chat so I know that we understand this completely? I am not saying at any point, go and invest in XY company, right? Excellent stuff. Excellent stuff. So, little reminder before we do, obviously the Money Mechanics tickets, we've already started to fill up, which is amazing. I'm excited to have you guys coming to see us. If you've not got your ticket yet for Money Mechanics Live in March, you will need to do it before midnight tomorrow. You've obviously got tomorrow, so I know a lot of you will get paid tomorrow, so you're waiting until tomorrow, which is fine. Loads of you have messaged me in the chat saying it'll be on Friday. That's totally fine. Just make sure you don't forget, because otherwise at the weekend it's going to be £650 plus VAT. What we want you to do is to get it at the 295 plus VAT and to be able to split it into 3 installments if that makes it a bit easier for you. So definitely make sure that you do it before midnight tomorrow. Get your name up on the star wall. So the garden of growth. There's 5 core components to this. And putting it into a garden analogy just helped me to better understand and explain what the different layers of a really solid diversified portfolio are and why they matter. So let's talk about diversification first, right? Why do you think that diversification matters? What is it? Why does it matter? Why is it important? Tell me in the chat. Why is diversification important? Get a little swig of my water while I'm waiting for you all. What is it about diversification that is important in a portfolio? So you're not putting all your eggs in one basket, yeah? But what does diversification do? Obviously, diversification is not putting all your eggs in one basket, but why don't we put all our eggs in one basket? What is it that diversification is actually doing for us? Stick it in the chat for me. What do you think? Just have a guess if you're not sure. Have a little guess. Stops it being too risky, acts as a hedge, mitigates risk. Exactly this. Well done. This is exactly right. So diversification, really having different types of asset classes in our portfolio, means that if one market is going up, maybe the other market will be coming down, or other markets will be coming down. If one industry is going up, then another industry might be going up. Another industry might be coming down. It allows you to ride the wave a little bit less chaotically, right? So what I've done is I've taken kind of the core, I would say, beginner to intermediate investment types, and the Garden of Growth explains what they are and how you can benefit from them without too much risk. So the first layer in your Garden of Growth is property. It is the old oak tree. If you imagine you're looking out your window and you see a beautiful garden, you've got oak tree right in the middle, cheeky little tree house in it. Like, it's stable, it's reliable, it's there, it's bricks, it's tangible. Yeah, it's strong, it's weathered the storms, like it's there, it's reliable, right? So property in a portfolio is like your oak tree in a garden. The benefits of property are capital appreciation. I put a post on Facebook about capital appreciation. Interestingly, it's been a very interesting response. There's a lot of men trying to mansplain money to me, which I love to handle. I've had 59 men try to tell me that I'm wrong about money, which I love. And I've had 2 ladies say, I love this, Sarah. I really found that interesting. I'm not sure what that tells us about men and women, but I think it's quite an interesting piece of data. Obviously, the boys that are all on here, you're all very cool. None of this is meant for you. It's the men on the internet in general that are just a bit of an interesting group of people. So property does give you capital appreciation. We hope. It doesn't always. Now, I know people say, but property doubles every 10 years. And, property, it's the only thing that will definitely go up in value. Incorrect. Not factual. Property does go down in value too. Yes, demand is going up. Yes, supply is going down from a rental perspective. And property does generally go up in value. But is it actually a great investment if it goes up in value less than what it's cost you to own it for the period of time that you have it? Maybe not, right? I would say that the property you live in is a liability because it drains your resources to have it. I would say that if you've leveraged and you've borrowed money to buy a buy-to-let or something like that, then that's an investment. And that is going to be turning up a cash flow, we hope. Property has the ability to be a great investment, but it also comes with its wobbles, right? Wobbles. The market has wobbles, but also from an investment perspective. I'll give you an example of a real life example today. I've got I own 2 properties in Scotland that are unencumbered, no mortgages on them. And one of them, where they've had like really bad storms up there, basically the ridge of my roof has come off and my chimney needs rebuilding, in summary. It's a sexy picture they sent me from the top. And I've got a tenant in there. Obviously, the water's just getting in. It's ruining all my walls and all the things. Well, my new roof, the repairs to the roof. It's not a brand new roof. Touch all the wood, hopefully. It's going to be about 1,500 quid. Now, the rent on that house is £600 a month. And obviously, it's not mortgaged. So we get most of that, which is great. But obviously, it's my money that's in there that's paid for that. It's still my money invested. And We've also had challenges with tenants not paying rent in that same property and tenants damaging things in that same property. So, every time that you have a tenant in a property, you're still risking your investment. Yeah, there's still volatility attached to that investment. So having an oak tree in your portfolio is definitely something that I think is a very standard, understood, positive thing. Buy well, buy in a good area, understand what you're buying, that sort of thing. But property is not actually accessible to everybody, because in order to buy a property, you need some sort of money, right? Now, I'm just deciding whether I should or shouldn't buy a property in the Lake District to run as a service accommodation. It's worth 210. I'm getting it for 130. We've managed to negotiate a deal with the seller, and it'll probably generate between 20 and 30 grand a year from rent, like SA rental income. On paper, it's a great investment, but I have to think about, will that be a good investment in terms of maintenance, management, all the things? But to actually get into it, even though I don't need any actual money, because of my financial position, I can get lending that gives me £130,000 on day one. I don't need a deposit. I don't need that bit, but I still need stamp duty, and I still need solicitors, and I still need fees, and I still need the broker to be paid, and I still need to hire a management agent. There's still that stuff that goes with it, right? So property isn't accessible to everybody. You can borrow money, of course you can. Raising private finance is a big topic that I talk about in my property education company. It definitely exists as a thing that you can do. Not everybody wants to borrow other people's money like that. Rent to rent, you could make money from other people's properties and other people's assets, but you still need money to get started. So if you haven't got the money for a deposit to buy a buy-to-let, and you don't want to raise private funding, then property actually becomes a bit difficult, right, to get started. So what could you be doing in terms of your portfolio to get you to the point where you're ready to go for property if you can't get there right now, or it's not right for you right now? So the next layer in the garden of growth is the hedges in your garden, okay? Your hedge that goes around your outside garden of your garden. What does a hedge do? In the comments, tell me. Tell me. What is a hedge for? What is it for? What does a hedge do? Actually, in your physical gardens that you live in, like where you're living, what does a hedge do? It protects. Thank you, Jason. It certainly does. Thank you, Susan. You said the same thing. What else does it do? So it protects against outside getting in. Yeah, it protects against wildlife. Yeah, from getting in. It gives you privacy. But what else does it do? What else does it do? It stops things getting in, protects you. But what else does it act as? What else does it do? If it stops things from getting in, it also stops things from getting out. Yeah. So if you've got kids or dogs or, just general things you want to keep in your garden, keep safe, the hedge is what's stopping. In my garden, it's a wall, but in lots of gardens, it's a hedge, right? So it gives you that protection. So a hedge in a garden, if you imagine that, is the same as what a defensive stock would be in your portfolio. Now, a defensive stock is a stock that is, tried and tested. It's been around a long time. It's the reliable household names. It's your Unilevers, your Coca-Colas, your GlaxoSmithKline, your companies that you've heard of. We've all heard of. We all know them, right? When you look at the charts of those sorts of companies, actually, you'll see that they kind of tick along. They do this a bit. What they don't do is this, like ice hockey. If you imagine an ice hockey stick, it's called a stick, right? An ice hockey stick. Yeah, I'm pretty sure it is. You know what I mean? Anyway, like some companies, ice hockey stick, it's got a real curve like this. That is not what a defensive stock is going to look like on a chart. Defensive stock is going to just kind of tick along like this, maybe a bit up, maybe a bit down, doing its thing. But generally, because they're companies that are well established, they've been around a long time, they typically, over time, if you invest for the long term, will return good yields or good dividends for investors, for their shareholders. Now, a defensive stock is something that is going to protect you when or if the market gets volatile, because often defensive stocks are the ones that can kind of carry the weight when all of the crazy other types of investments, which we'll talk to you about in a minute, are all doing this. Defensives are still ticking along, trundling along, doing their thing, right? So a defensive stock is a company that's been around for a long time. They don't offer, really high returns. They're not particularly sexy. They're not like going to be very exciting. However, if what you want to do is feel quite protected in your investments and feel quite safe in the choices that you're making, then playing quite defensive is a good idea. Does that make sense? So again, this is all about you picking your strategies. It's about you determining what your risk profile is. It's about you determining how you can best approach starting to create that financial independence, security, wealth, all the things. Now, if property is not quite there yet and you're working towards that, most people can afford to get into some quite defensive stocks with very little money. So I'm going to give you some examples. Again, these are examples for education purposes only. This is not investment advice. If I take a look at my free trade account, so free trade is the account that I use to do all of my buying and selling of shares, investing long term. I don't really sell anything. I only really ever sell when there's stuff happening in the news where I think, I don't really like this company anymore. I'm going to take my money out. So let's say that a company like Coca-Cola is quite defensive. So we'll use that as it's the highest up my list. Now, with Coca-Cola, what's great about Coca-Cola is that you can buy what's called fractional shares. So let me just explain what a fractional share is. If you imagine that a whole share is £100 in a company, but you only had, I don't know, £3. Well, you can buy a percentage of a share. You don't have to buy a whole share. So you can buy what's called a fractional share, and you can do that on free trade as well if you want to. It's the same with crypto. We'll talk about that in a minute. You can buy, not many people are going out and buying a whole Bitcoin at the minute. Yeah, they're buying bits of Bitcoins. I don't own a whole Bitcoin yet. I'm working on it, but I don't own a whole one yet. I buy bits of Bitcoin, right? So with defensive stocks, we're looking at companies like a Coca-Cola. Now, when you look at a Coca-Cola, if I show you the trend, I don't know if you can really see it on here, but basically like this is, you see how it's not really doing, I don't know if you can see it very well. Hold on, my camera might be a bit grubby. Hold on. Let me just clean that for us. See if we can make this bit. Oh, look, I look better now. That's good. So you might be able to see this a little bit better. You see how it's not really doing anything like super sexy, but it's just kind of ticking along, doing its thing. When you look at a chart, this is quite most defensive companies are doing that sort of pattern. Yeah. So what you would do is you can look at it and think, okay, I've heard of the brand. I often will invest in things that I consume. So I actually don't consume Coca-Cola unless there's Jack Daniels in it. It's very rare that I drink Coca-Cola. But Coca-Cola as a company, I think, that's quite a reliable, sustained, long-term business. That might be good for me. The thing about defensive is that they're often lower risk than the kind of growth stock. So, a growth stock would be, Nvidia. I'll give you that as now. Nvidia is like filling up the news this week. Nvidia in the last few years have just literally done this. They've gone from nowhere to being one of the most valuable companies globally. And the thing about Nvidia is it did this hockey stick style. Well, that's what's called a growth stock. And when you invest in growth stocks, usually they're startups, they're bringing to the market a new piece of technology, they're bringing to the market some sort of research that we've not seen before. These are companies, growth like Apple, Tesla, Meta, these are like growth companies. When they first came to the market, their intention was to come in and disrupt. That's what they were trying to do. That's your growth side of things. Now, the thing about that is when you're trying to work with a company that's intention is to be disruptive and ultimately create volatility, you're investing in a company that's going to be volatile, right? Because you don't really know whether it's going to do this or whether it's going to do this, or it's going to do this. No one really knows. Defensive hedging is going to be a slightly safer way for you to get involved in these companies without going for the ones that are like the big uptick trend. Now, defensive stocks are not going to make you super rich overnight, unlike a Nvidia stock, which a lot of people, bought a few years ago and have done very, very well. I don't know, like 2,000% or something, 8,000%, a lot. I did not buy Nvidia stock. Sadly, I missed that trend. But you can research when you start to research. And we talk about how you research at Money Mechanics Live, like the technical, like the actual fundamental analysis that you'll do. But as you start to do that, you'll be able to recognize, actually, this company looks quite defensive. I've heard about it. I know what they do. I understand what they do. They've been around a long time. That could be an option for you. Now, obviously, past performance is not a predictor of future performance. You look at a company like Woolworths. None of us expected Woolworths to go bust, right? But they did. So when you're choosing defensive stocks, it's important to really think whether or not stocks is the right move for you, or one of the other options, which I'm going to talk to you about in a second. So any questions on that, on defensive stocks specifically, or property? Any questions? Hedgehog hiding places. I love that. Any questions about defensive stocks? I appreciate I've got a bit of a delay on my chat tonight. So we're going to talk about the fruit trees of the garden of growth next. So a fruit tree in its very nature, if you imagine in your garden, we'll visualize your garden for a minute. Bill, I'll come back to you about that in a second. So a fruit tree, every year, in its very nature, if you had an orchard in your garden, you would get fruit every year. Yeah, if you've got one single apple tree in your garden, you get apples every year. I know for a lot of people, they've got fruit trees and they don't really eat the fruit, and the fruit ends up on the floor and it's a bit of a pain in the ass. But actually, that's not the case with dividend stocks. So dividend stocks are our fruit trees in your garden of growth. So in your diversified portfolio, dividend paying companies are a really interesting way for you to consider just doubling down or growing that pot of money as quick as you can. So the thing about a dividend stock is, just like an apple tree, you will be invested in it, and every quarter, usually it's quarterly, some it's every 6 months, but usually it's quarterly, the company will report on, or the fund will report on, their profitability, their success, what they've done. And if they are a dividend paying company or fund, they will distribute percentages of profits to their shareholders, right? So you will be a shareholder in the company or in the fund because you've invested in it. So you are now a shareholder. Because the company has done well and made a profit, and they are a dividend paying company or fund, they will distribute a portion of their profits to their shareholders every quarter. And as a shareholder, what that means is they just drop money into your account. Yeah. In the same way that you're a limited company, if you guys have got your own companies, you're a limited company now, you are a shareholder of your own business, you're a shareholder of a privately owned company, you own it. Whereas when you become a shareholder in a stock or a publicly traded company that is traded on the stock exchange, right, you are able to benefit from the distribution of profits to shareholders as a shareholder. Okay, so I love dividends. They're my absolute favorite. They're my favorite because I own a small percentage of many different companies, and via funds and also directly through stocks. And because I am a shareholder of that company, I just get a little pot of money drop in my account every quarter. Now, what I do is I reinvest that money back into my investment pot because I see that as free money. Like, I've earned a dividend. I haven't done anything for it. I haven't had to run the company. I haven't had to turn up at a meeting. I haven't had to deal with any staff. I haven't had to hire anybody. I haven't had to worry about money in the company. I haven't had to do a thing. All I've done is buy shares, believe in the company or the fund, and I get a portion of profits distributed to me. Because I'm tiny in the grand scheme of their shareholders, there are some shareholders, if you're like a majority shareholder, you'd probably sit on the board, right? And you'd be involved in those decision making. But as a shareholder at our level, we don't have to worry about any of those things. So your fruit trees in your portfolio, in your garden, are dividend paying stocks and funds that are going to consistently distribute percentages of profits to you as a shareholder in the company, right? So I'm just going to answer this question. Bill Clinton, hello. Are you recommending defensive stocks for capital protection? How about bonds? So bonds aren't something that I talk about on Challenge, because they're the garden of growth, the 5 layers that I think are the best for beginners. I think understanding the different layers is important. There's other categories of investments. There are bonds. There are lots of other ways and means that you can invest your money. You can trade your money in different places. I'm not recommending anything on this live. What I'm saying is that these are the different categories that you could consider investing in. And what you have to do is work out which one of these categories, if maybe a selection of all of them, but which category is the one that makes the most sense to your investment strategy, to your financial and wealth building strategy over time. It might be that property is it, the oak tree. It might be that defensive stocks are it. It might be that bonds are it. But I think it's important, first of all, to assess what it is your strategy is, like what it is you're trying to do, what's important to you. I do invest in bonds, but it's not something that we talk about on this 5 days, because I think it muddies the water a little bit from what we're talking about. So hopefully that answers that question. To come back to dividends, has anyone any questions about dividends? I absolutely love dividends. Again, it's not investment advice. I'm just telling you what I like. I like the fact that I get paid. I'm not just relying on compound interest over time based on a return from the market. I'm actually being paid a chunk of cash every quarter. It feels quicker. It feels like it's happening. I feel like I can see it. It's tangible. I can put that money where I want to put it. Or I can take that money and spend it if I want. Now, obviously, any income that you earn on any investments, you have to declare to HMRC. That just comes as standard. None of this is tax-free. None of long-term investing is tax-free. If you do like foreign exchange trading and spread betting, that becomes tax-free, but that's not what we're talking about here at all. You're right, Jason. The dividends are not guaranteed. Nothing is guaranteed in investing. Nothing. There is nothing that you can guarantee. You can't guarantee if the market's going to go up or down. Can't guarantee what the dividends are going to be, because you don't know what the profitability of that company is going to be. So again, we don't ever invest what we can't afford to lose. We don't ever invest all of our eggs in one basket. You can, instead of, if you wanted to go down a dividend route, you probably wouldn't pick one dividend fund or one dividend stock. You might look at splitting across the different industries. Like there's 11 different industries. You've got tech, you've got healthcare, you've got big pharma, you've got consumables. Like there's different industries. And when one industry goes up, sometimes the others come down. So it's important that you start to really not just diversify in terms of type, but also in terms of like industry and sector. That we're digging into a lot more of the detail that we cover on Money Mechanics Live, because we talk about fundamental analysis and how to physically actually assess and look at a company and choose it or discount it if it doesn't work for you and your strategy. But no, you're 100% right, Jason. Dividends are not guaranteed. Nothing is guaranteed in investment. Nothing. And nothing is guaranteed in savings accounts. Nothing is guaranteed at all. In a savings account, you don't know what your interest rate is going to be. It's going to go up and down, like it has done for many of us. Up to 84,000 or is it 85,000? Up to that level is protected in terms of bank accounts. So if you've got £84,000 in a bank account, it's protected by the government. Anything over that, it's not guaranteed either. So it's important to really think about what we're choosing. And as we're choosing, we need to make sure that it aligns with our strategy. It is as low risk as we can make it, and that we've thought about what the risks are going to be. So hopefully that makes sense. Does it tell you in free trade which are dividend stocks? Is it a category? Yes, it does. So let's see if I can pull it up for you on here. So when you go into free trade, if you go to let's see if I can get it to work. Hold on. Log in for me. Of course, it's being slow when I need it to not be. Hold on. Okay, so when you hit on right at the bottom here, there's a little, if I can get it to pick it up. Can you see? You see there's a little magnifying glass in the middle, this bit here. This bit shit, isn't it? Hold on. Right there in the middle. It might be better if I do it from here. Ah, there we are. Right in the middle here, there's a button that looks like a magnifying glass. It's called Discover. And when you do that, you basically can scroll through the different categories that are on there. And those of you, by the way, that haven't got a free trade account, I can send you a free trade link that will give you a free share when you put £50 in your account. They will also give me a free share just for full transparency. So, you know, it's like an introducer's link. But it's a great way for you to get started if you want. So if you scroll all the way down, Amanda, if you've got this and you scroll down to D, it's got dividend income funds and it's got dividend income stocks. So then you can scroll across. They're the ones that are funds that are paying dividends, and they're the ones that are stocks paying dividends. So yeah, they're pretty easy to find if you want to find them. And yeah, hopefully that makes sense. So dividends, they'll pay you a percentage of the profits that they are distributing to shareholders. And again, once you click onto one of them, you open it up and you can read. So if I just click on Murray Income, which is the top of the list, these guys pay a 4.56% dividend yield. And this is a fund, so it's an ETF, an exchange traded fund. And it's £8.55 to buy a share in Murray Income. They've seen a 5.8% increase in the last month. Then, you know, it gives you all of the data like on the page. If I hold it at a slight angle, it helps me to show you. But all of the info is there for you to start better understanding it. Okay, so dividends, that's, you know, I love them. Might not be for you, but it might be. At least you know what they are now. Then we've got the flower beds in our garden. So we've got the oak tree, we've got our hedges, we've got our fruit trees giving us fruit every quarter. And now we've got flower beds. So what is a flower bed in a garden? Like when you look at a beautiful garden that's really established, what tends to happen inside of a flower bed? Tell me in the comments, what tends to happen? It's a mixture. Yeah, it's a mixture of different things. It could be large companies, small companies. It could be different blooms at different times. You know, different times of the year are good for different industries. So imagine a flower bed. It's got loads of different things in it. You know, it's got some weeds in there. It's got loads of beautiful flowers. It's got tall flowers, short flowers, big flowers, little flowers. It's like a plethora of fun. Well, that's basically what an index fund is. Yeah. So where if you imagine a stock or share is like a single rose, and a fund is a bouquet of flowers, a flower bed, a mixture, that is what a fund is. So a fund is there's different types of funds. There's ETFs, there's index funds, there's mutual funds, there's lots. And I wrote a whole chapter about this in the book. So anybody who's ordered the book, I highly recommend you read that chapter. It explains it really well. But basically and there's also dividend funds, right? So what you can do with a fund is instead of choosing one share in Coca-Cola or A&R company, not legal advice, not investment advice, you can think, do you know what? I want to protect myself even further. I want to diversify even further. So I am going to pick a fund that's got lots of different companies in it. So if I give you like an example, the S&P 500 is the 500 biggest companies in the UK. No, in the US, sorry. 500 biggest companies in the United States. So the S&P 500, it stands for Standards and Poor's 500. It's the top 500. So when you buy a share in the S&P, which at the moment, I'll tell you how much they are £92.37. So if you want to take your £92.37 and you want to buy a share in the S&P 500, what you're actually doing is buying 500 pieces. You're buying a share in all 500 companies that are inside that fund, right? So that's really diversified. It's really protective, because if one of those 500 goes bust, they replace it, and 499 others in that fund are going to buffer the storm. Yeah. Now, obviously, it's tracking a market. It's the 500 biggest companies. So, if there was a massive drop, which actually hold on, let me find what day it was. It was this week, between the 24th of January and the 27th of January, there was a significant drop in the market. You can see it on this chart here, right? What that basically means is the whole of the market moved. So the S&P 500, that big drop, actually a lot of it was triggered by the Nvidia drop. So Nvidia is a company that sits inside of the S&P 500, and Nvidia dropped by 615 billion overnight, the biggest market shift we've ever seen in a company. And so it dropped substantially because that company inside of that fund dropped so substantially. Now, that's rare. It does happen. Obviously, there's no guarantees. There's always risk. But it's rare that happens at such a big route, at such a big level. Now, obviously, when Donald Trump was announced, back in whenever that was, I don't remember. I know he's in now, but when he was announced a couple of months ago, maybe October time, I can't remember when it was, end of last year, the S&P 500 shot up by about 20% overnight because the markets liked the fact that he was coming in. So these political things can impact the markets. These decisions that are happening outside of the markets will impact the markets, right? But if what you want to do is, instead of relying on Nvidia to look after your money, you want to rely on a fund that's got Nvidia in it to look after your money, then a fund is the route for you to go. There's pros and cons to both. You might decide to do both. The thing about a fund is that it gives you another layer of diversification, and you haven't got to track 500 companies and check their charts and know what you're doing, and you haven't got to pick 500 different things. There's different funds for different categories as well. So there's funds for large companies in America, not the biggest. There's companies for there's real estate investment trusts, which is not a fund, it's a trust, but again, it works with it will track the values of real estate that they own inside of that trust. The thing about there's renewable energy funds, there's insurance funds, there's all sorts of funds, right? So you can look and think, actually, I want to invest in these sorts of companies. I was just putting up a list. So you've got like banks, you've got City of London funds, you've got Free Trade's not being kind to me today. It's being a bit slow. I apologize. Come on, be kind. You've got finance funds. You've got all different. You've got there's the all world. So it tracks all of the publicly traded companies. There's all different funds that you can pick from. And again, I can't say to you, this one's better than that one's better than this one's better than that. That's something you have to go and figure out. And that's why you need to learn how to appraise these things and think about it. The key to it is really deciding what works for your strategy. Funds don't work for everybody's strategy. They work for mine, but it doesn't necessarily mean that's what you want to do. You might decide that actually you want to go for stocks that are going to do this hockey stick vibe, and you want to go for that kind of real higher risk consideration of volatility, and you're prepared for that. That's up to you. But for a lot of beginners, what they really want to do is to start learning about this stuff by doing without risking huge amounts. And I think when you look at that as you're trying to do, working in the most diversified way that you can is always a good idea, right? And then the last layer of our garden of growth is the exotic plants, right? So we've got our property, it's in there, our oak tree. We've got our hedge around the side, defending us, keeping us safe. We've got our fruit trees feeding us, all is well in the world, and our flowers are keeping us diversified. The exotic plants are the pains in the ass of this. They're the risky stuff. They're the stuff that's like, if you get it right, it is fucking epic, but it's more likely to go wrong. Yeah, you're more likely to lose because it is very volatile in that space. So your exotic plants are your crypto, your foreign exchange trading, like these sorts of things. Now, I've made a lot of money in both of those, but I've also lost some money in those as well, right? So I own Bitcoin. Bitcoin's going up at the moment. I've made money there, which is great. But I've also bought crypto coins. I bought SHIB. My brother rang me and went, buy SHIB. And I did literally that day. I did no research, no due diligence. I broke all of my own rules. I don't know why. That particular day was a terrible idea. And I bought 11 million. So all I want ever for Christmas is for SHIB to go to $1 and I'll be happy days. So I definitely won't be in the UK anymore. I'll be moved to the sunshine, that's for sure. But I've lost money with that. But I've made money with Bitcoin. So again, the exotic plants are like, you know, if you were trying to grow a very fancy orchid, these are not real, sadly, but let's say you're trying to grow a really fancy orchid outside in the middle of York and with absolutely no warmth anywhere, like not that York's cold, but everywhere is cold is what I'm talking about. You know, it's going to be hard to do it. It's going to be hard to get it right. It's a struggle to grow exotic plants in the UK because we're not really built for it. We're not geared up for it. It's likely to fail. It's more likely to fail than not. That's the approach that I would take as a beginner to things like crypto, foreign exchange trading, this kind of alternative investment, right? Because, you know, trading isn't actually investment either, which if I just clarify, I know a lot of you read the book, so I don't want to repeat too much that's in the book because I know a lot of you have read it, but some of you haven't. I would call myself an investor. I buy and hold long term. My husband, I'd call a trader. So he buys and sells, buys and sells, buys and sells, buys and sells. Yeah, so he's either long in the market, short in the market. He's buying something, hoping it goes up. He's creeping that profit off. I'm an investor. So I buy and hold. So my strategy is to buy Bitcoin. I buy a bit of Bitcoin every week and it goes up and up. And as the market moves, it will do its thing. I buy into funds every week. I use a thing called dollar cost averaging or pound cost averaging, depending where you are in the world. And this is something that I think you should all understand. So dollar cost averaging is where you buy the same amount of the same thing at the same time on a consistent pattern. So this is where automating your money will really come into play. So you don't forget, you can be super disciplined without being really disciplined because tech can do it for you. But let's just say that you decide, right, I'm going to buy one S&P 500 share every month. So I'm going to put £92. Instead of saying I'm going to buy one share, which could go up and down in price, different prices, might be £120 next week, might be £40 next week, who knows? What you do is you say, well, I'm going to buy £90 of that thing every month forever, for as long as you want to do it, right? The thing with dollar cost averaging is you're not waiting to time the market. You're making it the right time by always just buying consistently on this line. Now, what will happen is the value of the thing you're buying will go up and down like this along the line. If you can imagine the lines here, that's where you're buying. That's the price. That's the amount that you're buying. But the price is going to change over time, right, on your charts. Well, if you're somebody who doesn't consistently just buy all the time on a consistent pattern, what you're going to end up doing is waiting to time the market. So what will happen is you'll buy here, then you might drop. Then you might not buy anything because you're a bit pissed off about it, you lost a bit of money. Then you might miss the next bit. You're trying to like time it. It's actually What they've proven now is that if you just buy the same amount of the same thing at the same time consistently on a pattern, you will be able to beat people who are, unless you're like a proper fund manager, you wouldn't be on this session if you were. For us kind of people that are doing this behind the scenes of our real life, we've got jobs or businesses or whatever we're doing. What you want is easy, simple to do, dollar cost averaging. You automate it, the same amount of money into the same thing at the same time. Some days you might get 1 share of something. Other days you might get 4 shares, and other days you might get half a share. But actually, consistently over time, it's proven that that strategy will beat somebody who is trying to time the market. So the key to, I think, to getting started and moving yourselves forward with, starting to decide where and how to invest, it starts with thinking about what are the objectives I've got behind what I'm trying to achieve. Yeah. So what is it? Am I trying to look for something that's quite protective in its approach? Am I trying to do something that is, is my play money? In which case, maybe Bitcoin would be a great thing. If you want to go quite protective, you probably want to go for something that's very defensive or something that's very diversified, like a fund. These different categories, when you start to really think about them, what they're for, what they're designed to do, it will help you to make decisions. And obviously tomorrow, the last day of the challenge, your task, I won't tell you what your task is yet, but what you're going to be doing is making some decisions, right? And making those decisions, when you're starting with no information as to what all the different moving parts potentially are, it's really hard to make decisions. So now you've got a good understanding of what the different kind of starter ones are. There are lots of others. There are bonds. There are growth stocks. There are, there's all these different things. But I think it's important to think, what is it I'm trying to do? And how do you then layer on top of that over time so that you can be quite protected, but still get started with confidence, right? So let's have a quick look and see if there's any questions we've got going here. Yes, it does tell you. So most mutual funds fail to beat the index. Why does that happen? This is to do with passively and actively managed funds. So an index fund is like passively managed. All it does, its job is to just match the market. Whereas actively managed funds, they're designed to try and beat the market. And often in trying to beat the market, they fail. And so actually they don't beat the market. Whereas an index fund's job is to just track the market. So if you look, again, I wrote about this in the book, but the history of this, Vanguard set up the first index fund. He was like, well, actually, if it's just passively managed to match the market, can't really go wrong. Whereas when you're trying to actively beat the market, sometimes you get it wrong. And what that creates is losses, basically, or bigger losses. So mentioned dollar cost averaging, but what if during a crash I move my entire fund into bonds and then use new money to buy the dip? I just don't want my total amount to decrease. Would this be a better strategy? So I can't tell you whether that is or isn't a better strategy than what you're doing. Like, my job is not to advise you on whether to do this or do that. My job is to help you to better understand the options that are available to you so that you can go and make them. Yeah. So, bonds are in a market crash, when government borrowing is up, all these sorts of things. Bonds are a good place to put money. However, that being said, they are not always that exciting. So during a crash, maybe, but are they the place that you'd want? Are they the place that's going to be where else you could put your money? Does that make sense? I can't tell the answer, yes, you should do that, or no, you shouldn't do that. But I understand that. And I think I can see the pattern that you're trying to create there. And if that was right for you, then that would make sense for you. But I can't tell you whether it's a better or a worse one. My job is not to advise you on that stuff. My job is to just help you understand the differences. You can't do that on free trade without upgrading and paying. What bit, Amanda? So you can buy and sell on free trade if that's what you're talking about. I buy and I sell on free trade, and I've got the free account. Have I got the free trade link in here? I don't think I have. Hold on, I'm going to put the free trade link. I'll probably WhatsApp it to you all actually, because that might be just a bit easier than getting it out my phone. But hold on, let's see if I can get it. Send a free share to a friend. That's what we want. Hold on. Copy. Let's see if I can paste it here. Hold on, let me see if I can just get this link for you all. I think it will be a like squiggly one with loads of different names and numbers and whatever. Oh, hold on, I've got a QR code. That's helpful. Let me see if I can put this QR code up on the screen, because then you'll all be able to just scan it. One moment, please, callers. Just bear with. Bear with, bear with. I need to save that as a PDF. How do I do that? Export as PDF. Save. And then I should be able to, no, don't do that. I should be able to share. I think it's working. Hold on. So that QR code, if you scan that QR code, that will open up the free trade app, and it will take you through to a page that says claim your free share. Now the share usually is valued between £10 and £100, depending on, they just give you it at random. So that'd just be a good starting point for you. What you'll have to do, so when you set up your account in there, you will have to fill in all your information. You'll have to put your tax information in, because obviously any income from this, any uplift is obviously taxable. The joys of the British tax system, but it is. And then you'll need to put £50 into your free trade account. Now you don't have to invest that £50. You just leave it in, like they've got like a bank account in there that you just, like a cash account. So put £50 in, and then they'll give you your free share. Don't invest your £50 yet unless you want to, but I wouldn't to start with while you're learning. And then as you start to watch your free share, learning what the buttons do, how to read it, all that sort of stuff, then when you're ready, get started. So, Amanda, I see what you mean. So yeah, what you do is you do it via like an automatic transfer from your bank. So I've got a Monzo standing order set up. So every Saturday morning, the same amount of money goes from my bank account to my free trade account. And I know that I'm buying this and this and this. So I just very quickly on a Saturday morning, I'll go into my account and I'll be like, right, okay, I've had a dividend going today, £25. Happy days. £25.26 has landed in my account today, which I wasn't expecting. So I will take the money that's sitting in there, and I'll go, right, buy that share, that share, that share, because I always do it on the same day every week, and I always know it's the same amount, regardless of what the price of that is. I just buy whether it's like one share, whether it's like 0.5 of a share, whatever. So you can do it via automatically transferring the money over, and then you just go in and you set it up. Yeah, dollar cost averaging just means you're buying regularly, which you definitely can do. Yeah, so a market crash will obviously drop your money. It will drop the value of your money, but as long as you still own the shares, then you've not lost your money. So, you know, there's a lot of people that sold all their shares in the 2008 crash and crystallized the loss. But I know people that just rode with it, and their money has like come back and some, because they just held their nerve. I think it's important that, again, we come back to what's the strategy for us as individuals. You know, if your money's dropped by 50%, then you know, I would be thinking to myself, well, do I want to crystallize a 50% loss? Probably not. I again, this is not advice, but my thoughts are I can't see a global market going to zero, because if it does, we've got bigger problems. You know, we've got much more important things to worry about if, you know, the global market goes to zero. So if you sold when your money had dropped by 50%, then yeah, you would lose money. That's when, you know, when you hear people talking in the pub about, oh, my uncle lost all his money in the stocks and shares. And you're like, did he lose it all because of that, or did he sell it? He chose to sell it and crystallize the loss. Yes, Jason, you've explained that better than I could have. You have to upgrade to create a recurring order, but you can do it manually by just automating and then going in and buying at the same time. So yes, thank you for explaining that. Okay, so we're almost at the end for this evening. We've got through a lot tonight, and you know, I want to make sure that ready for tomorrow, as you're starting to make some decisions. You might still feel a bit like great. You're like, I don't really know. That's fine. Don't panic. Obviously, we've got a whole nother training session tomorrow night. And tomorrow night's training is actually very much led around questions and answers based on your task tomorrow and any other task. So tomorrow's our closing party. Grab a little glass of fizz or something. You've all worked super hard this week. Thank you so much. And, you know, I'd love the opportunity to answer anything that you've got that you want asking. I know a lot of you are messaging me on WhatsApp, which is absolutely fine. But sometimes it's great to ask these questions in a group environment, because I can help everybody with that thing. I can just help you to better understand it. So has anyone got any questions for tonight before we finish, or are you all good? I'm going to wait because I know there's a little bit of a delay. While I'm waiting for that to see if anything comes in, just another reminder, please don't miss out on the Money Mechanics Live price going up on tomorrow night. Those of you that are coming, those of you that have booked your tickets already, congratulations. Your seats are booked. They're there. You're on the wall. I want you all to get your name on the wall. I'm going to upgrade you all to VIP, so you get that extra VIP treatment on the day. Also, remember that if you book before tomorrow night at midnight, you can also split your payments into 3 installments if you want to. So I'm going to put the link to the event so that you've got it. It's www.sarahpoynton, just my name, .com/Money Mechanics Live. So go on there, pick whether you want 1 ticket, 2 tickets, however many people you're bringing, and get it booked in. Because Money Mechanics don't overpay for things, right? We don't need to overpay for things. And I appreciate I've dropped this on at you at last minute notice, right? I get it. We're almost at the deadline. That's why we've done the payment plan, so that you can opt to pay £98.33 plus the VAT now, 1 in February, and then the 3rd installment is actually after the event. So you'll be paying at the end of the event. The other thing I probably didn't explain well enough the other day, I did WhatsApp you guys about it today, but there's a money guarantee on this, money back guarantee. So let's say you come, you sit for the event, and you think, all she's done is drag me here to upsell me something else. I've hated it. Come and see me at the end and I'll give you your money back. I know it won't happen. It's not how I work. It's not how our business works. We're not going to be upselling you to unlock this bit of information and pay this much money and that'll unlock that bit of information. It's not what we do here. Money Mechanics Live is an all-in. It's an intense day. We get into a lot of it. And, you know, I would love as many of you there as possible. It's going to be the next step. So like by the end of this week, you'll be in a place where you think, I got it. I feel a bit more confident. But now I just need a bit more meat around the bones as to how do I pick? How do I choose between a Coca-Cola or a Nvidia or another Unilever, whatever the companies are? How do I choose? How do I know that I'm making the right choices to the extent that we can know? So that's what Money Mechanics Live is all about. It's that assessment. It's that connection to your strategy. It's about defining the route through all of the millions of options that there are in the path of least resistance to your result without taking ridiculous risks, right? So I'd love to see as many of you there as possible. Let me have a little look. Can you start an emergency fund investing in relatively safe stocks? I'm not risk averse, so would rather have a chance. So Jason, my emergency fund is in my stocks and shares ISA. So I do invest my emergency fund. And if you're in a position where you can, if you know that you need new tire, let's say you woke up tomorrow morning and your boiler's blown, that you could probably make that work, and or you need new tires on your car or whatever, then you could do that. If you're somebody who's really like starting from the very, very beginning, has got no investments whatsoever, has got loads of debt and is trying to get to the point where they've got an emergency fund for the first ever time, I'd say don't invest that, because at that level, you want to be able to get to it. When you invest it, especially like mine's in an ISA, but it takes me 4 days to get that money out. So like I bought a car recently and I had to move. I was just wiggling some money around because it was just easier for me. And I'm in the middle of a refinance mortgage, so I didn't want to do a car loan while I'm in the middle of that. So I moved money out, moved some up and across, but it took days to do those transactions. So if you are going to invest it and it is your emergency fund, can you still handle an emergency if it comes, is all I'd say. If you can't, then don't invest it, because you might be able to get to it quickly. But if you can, then yeah, then why not? Is it better to own physical gold or gold ETF, since it sits with an ETF, you can time the market? I can't give you an answer as to which is better. Gold's done wonderful things the last 12 months. I don't know. I can't tell the answer. Is it better or worse? Because I'm not. You've got to make these decisions based on your strategy and what's right for you. And I can't say I recommend this over that. That's not my job. My job is to really just help you to better understand things. Precious metals is a fairly safe. I mean, we say safe. Precious metals will always be a thing. AI chips might not be. I mean, they probably will be, but they might not be. Gold, actual gold, I can't see a world where gold's not got value. So, precious metals are a consideration for sure. And we talk a little bit about that at Money Mechanics Live as well. I think the emphasis here is on long-term time the market rather than timing the market. Yeah, what we're talking about here is about long-term stuff. So you haven't got to be somebody who's watching values all the time with this weird anxiety of, oh God, did I miss something? Actually, we're just putting our money to work for us in the long term. We know what we're aiming for. We know how we're going to get there. We just put our money there and let it do its thing. Money mechanics is all about the simplicity. Yeah, once you're settled and your money's there and you're organized and you've got enough, then you can start playing with like fun stuff and you can start trying to time the market or trade in or whatever it is. But while you're getting to that stage, I would say that time in the market is definitely more beneficial. Yeah, so hopefully that's helpful. Thank you so much for hanging out with me this evening. It's been a pleasure. I'm a couple of minutes over, but I think that's okay. You've all got the link for Money Mechanics Live. Get your tickets booked tomorrow, if not today. Get your name up on the wall. And I will see you all tomorrow. You'll all get your link in the morning for day 5. And then I'll see you online on YouTube at 5 o'clock, as has been the case all week. If you've got any questions, WhatsApp me. If you've not got my number to WhatsApp me because you're watching live on YouTube and you haven't come through that process, let me know on YouTube and we can get that to you. Other than that, have a nice evening and I will catch up with you all later.